In this video, I want to talk about the 3 best ETFs for credit spread traders. If you're looking for something to trade, you should be trading these 3 ETFs on repeat. This is what I do and what my members do and what allows us to make 5 to 10% every single month. Why? Because they're reliable, consistent, super liquid, and other reasons that I'll talk about here. They're super profitable. So let's get into these 3 ETFs without wasting your time. All right, so number one, by default, we need to talk about why ETFs and why not stocks. Well, if you haven't seen my other video on why you should be trading credit spreads on ETFs, it's because they're diversified, they move slower, and they're not affected by single news and outlier risk. So your credit spreads by default have higher win rates. Not only that, ETFs are very liquid. All right, so the number one stock I like, which I assume you guys will know this, is SPY. This is one of the most popular ETFs to trade options on. Why? Well, because it tracks currently 506 of the top companies, and it's super duper liquid. So what does this mean? The 506 companies means it's really diversified, so a single risk and even one sector will be mitigated from other sectors, unless it's the tech sector, because I think the tech sector makes up roughly 10% of SPY. But anyways, you get the point, is that SPY is very consistent and very reliable, and we can trade credit spreads on it often because it's also super liquid. There's a lot of people trading these options, which means we can easily get in and out, especially if we're doing large size. For instance, I'll do 25, 30, sometimes even 35 contracts of spreads at a time. So that's roughly 70 contracts at one time, and have no problem with execution. So that's why I like SPY. We also have, and again, if you stay tuned until after I cover these 3, I'll go into the stats of why I like these stocks and the numbers behind it. Number 1 is DIA. This is the Dow Jones Industrial Average. Same reasons, very diversified, very safe, and has very good liquidity. But again, there's actually one with better liquidity than this. But anyways, so this tracks, I believe, 31 different stocks in the market. So again, these track the top 31s in the US. So not as diversified as SPY, but these still very closely mimic each other. Now, last but not least, we have Q, and Q. This is going to be our tech sector. That looks like a clock, not a Q. Okay, Q. So this is our tech sector. It tracks, I believe, 102 of the most popular tech stocks. Again, QQQ roughly makes up 10% of SPY. I say that as in SPY is 10% of tech. But anyway, this is a diversified tech. So this will move a bit faster, will move a bit quicker, because tech stocks are more of a high growth type of area. So again, if you're looking to invest in stocks somewhere, QQQ may be more advisable over SPY. But again, because QQQ does move a lot, this means that the stock's volatility is a bit higher. Thus, you're able to collect more credit on these trades. These right here, these trades are safe and consistent. These are also consistent, but you're going to have a lower win rate because you get to collect more credit, so you make more money on these spreads with that. So that's kind of the fun point with QQQ. Anyways, why do I like these? What are my stats? Well, when you employ a trend following strategy where you simply wait for the market to be trending up and you follow it, which is the turtle strategy right here. So this is an uptrending strategy, and you use it with credit spreads on SPY $1 with the uptrending strategy, you have a 93% historical win rate since 2005 with an annualized return of almost 35%. That's insane. That's awesome. DIA, what do we see here from the uptrending strategy? Let's let it reset. Go to the uptrending strategy. We see a 90% win rate with a 23% annualized return. That's awesome. You're literally 3xing the average market return. What do we see on QQQ for the uptrend strategy? We see a 90% return with a 26% annualized return. Why, if they have the same win rate, why are they different from DIA and QQQ? Because like I said, QQQ, you collect a higher credit because volatility is higher. So anyways, this is our annualized returns. You can see here all over 3 times the average market return simply by trading uptrends, credit spreads, put credit spreads on these 3 ETFs. All right, guys, I hope you enjoyed this video. If you're looking to learn more about credit spreads and how to profit from them, I am your guy. I come up with videos every single day for you, so click the subscribe button. All right, I'll see you in the next video.